For Morningstar, I'm Jeremy Glazer. The Federal Reserve didn't raise rates at their September meeting, but seemed to be open to the possibility of a December rise. I'm here with Bob Johnson. He's our Director of Economic Analysis for his take. Bob, thanks for joining me.
Great to be here today.
So going into this meeting, expectations were pretty muted that there was going to be an increase, and that's exactly what we saw.
Absolutely. I mean, I think that they left the door open for some increases later in the year. In fact, if the economy progresses as they expect, their expectation is that we probably have one rate increase this year, probably at the December meeting. So it was pretty much as scripted.
So what held them back? Was it just some of those kind of weak labor market reports, or do you think there were other things happening there?
Well, I think that they thought things were strengthening, but they just hadn't seen enough strength to cause them to act. They weren't particularly scared at the moment.
So it seems like the goalposts are kind of moving a little bit. We've reached a lot of the metrics, not inflation, but at least unemployment, that they're looking for over the long term. What would have to happen between now and December in order to make them feel comfortable enough to actually raise rates?
Yeah, I think the key thing would be continued improvement in the labor market. And I think they would have to see an increase in inflation as well. I think maybe one of the things that might be holding them back is that we've definitely had some food deflation in there that's really helped keep a lid on the overall inflation number. And I think that's probably given them a little bit more flexibility in their numbers. So, again, I think if inflation were to spike up, if the economy continues to strengthen, those would be all things that would cause them to act in December. But you always got to put the caveats, well, what's happening in the rest of the world, that could always hold them back as well.
Now, before the meeting, we talked a little bit about how you do see some signs of weakness in or weakening of the economy, I should say. Do you think there's a chance that December is not a done deal, that we could see zero increases in 2016?
I think it's a real possibility. I hate to say it. I mean, I've been when the economy was looking a little bit stronger 6 to 9 months ago, that maybe that would be the right time to put a little cushion into their numbers and start raising rates. But now they put it off this long, and now it looks like we're getting near the end of the recovery, and a lot of things are slowing. And this week there was even more of that. Architectural Billing Index dropped below 50, a key indicator of business spending on buildings. I'm just very worried about the data, and we've also seen the restaurant business begin to turn in signs of weakness as the gap between the price for grocery prices and food prices out diverge. We've seen a shrinkage in restaurant spending, and that's obviously helped drive the labor market and help numbers overall. And so there are a number of things that really look quite weak to me here, and even the housing starts and permits data was nothing to write home about. All of that tells me that the economy is likely to slow, and I think the Fed said as much in some of their forecasts as well.
We did get those forecasts along with the statement. They say this is what we think is going to happen with the economy. Even in the longer run, they see growth as being pretty slow. Is that something that should be concerning?
It should be concerning. It's something that we've talked about. It's just kind of a matter of trying to figure out where the bottom and what the offsets might be. But for this year, 2016, they dropped their forecast from 2% to 1.8%. So recollect that we're kind of in a range of 1.5% to 2% for this year. So they've dropped back into the middle of our range. And I'm kind of even thinking more like 1.5% than 2%. So I think they're probably still going to end up being a little high. They kept the next 2 years the same, with some hopes that maybe there's just a temporary thing in there. I don't think so. But they did pull down their long-term growth rate for the economy from 2% to 1.8%, which makes a lot of sense given the demographics.
So overall, you think this was as expected, December possibility, not a done deal, and the real thing investors should be thinking about is what's happening with longer-term growth, not what's happening with rates.
Absolutely. They're kind of watching a sideshow here while the real economy is continuing to kind of weaken here, and I would be very, very concerned about that.
Well, Bob, as always, we appreciate your analysis.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.